Welcome to the Heart of Wealth, your weekly pulse check on the wealth industry. Today, we'll be discussing the private credit storm, a massive asset management retention pot, and the AI threat. I'm your host, Dylan Lobo. First up, private credit chaos. Is the media panic overblown? Plus, Cazenove commitment. Nuveen drops 175 million to retain top Schroders talent. And finally, AI fears. Are wealth managers irreplaceable, or are they just kidding themselves? To discuss this, I'm joined by former Jupiter CEO Edward Bonham-Carter and Citywire US editorial director Alex Steger. Thanks for joining us, guys.
Sure. Thanks for having us.
Edward, it's great. And Edward, it's been a while since I saw you. You've had
lucky thing.
You've had quite a career, and now you are the first guest on our brand new chat show. I mean, the bucket
what
list.
What a pleasure.
I mean, does
that go higher on the CV?
Yeah, no, it goes straight to the top.
Straight to the top of the CV. Well, thank you. And Alex, you're not so great at saying sorry, are you?
Has he got something to apologise?
I'm not sure
that's the context here. What
so
does this mean?
This is our first story. This goes to our first story. The media is getting a bit of stick for its coverage on the gating in private credit funds. Now, last week.
It was last week. Yeah, okay, so I understand what you're talking about. You're saying I didn't say sorry. So I was on a panel with Lawrence Lever, Citywire chairman, founder, with 5 CEOs in New York, 5 CEOs of asset management firms. So we had Neuberger Berman, Morgan Stanley Investment Management, Guggenheim, Federated Hermes, New York Life Investment Management. And one of the big topics was private credit and what's going on there. And I think the apology or lack thereof you're referring to is one guy sort of said, well, hang on, some of this is about a little bit about the media and how the media's reported this, and maybe they've injected a degree of panic into the story that perhaps doesn't need to be there. And you're saying, well, I didn't apologise for that. I stuck up for the media.
Stuck up, you did. You did. Well done.
Some of this stuff needs to be reported.
So yeah, I mean, it's just not a good look, though, is it? I mean,
which is not a good look.
Gating these funds.
No. We've seen it before.
Report it. We've seen it before, Edward. I mean,
we've seen it before, and no doubt, Alex referred to it. It's the age-old thing of illiquid assets in funds which are marketed or sold as open-ended. And at some point in a cycle, no doubt we'll discuss where we are in the cycle, you're going to have a problem. And Alex is right to mention it. Fund managers hate having the light pointed at sentiment and confidence because it exacerbates the propensity for redemptions. And I suspect that's the pinch point with the media.
And I think the point I was trying to push back on is, well, okay, regardless of your take on some of the headlines, and there is an impact of those. Those headlines do have an impact. You do see sort of the effects of this behaviour. But at the same time, to Edward's point, there is a story there as well. Yeah. You know, like if you can't meet the redemptions of these funds, that means a lot of people are trying to withdraw their money more than you planned for. And there's a reason for that. And if there are a group of investors who are more flighty than you have historically sort of dealt with, then there's a reason for that too, because you've attracted those investors. So yes, some of the headlines may not be what the asset managers want to see, but that doesn't mean that there isn't a bigger scandal. Scandal might be too strong a word. But
and the confident ones should be okay, because it will ultimately come down to what is the underlying experience in the funds, what's the default rate, what's going on, and then sectoral composition and all the rest of it.
We are switching gears a little bit here, and we're going from retaining assets to retaining talent. Mm-hmm. Edward, we are looking at the staggering. Is it staggering? 175 million Nuveen has dropped to retain top Schroders human talent.
Human talent.
And that includes a commitment to keep the Cazenove brand. Now, is that enough?
Is that where it's good? I'm not sure. I don't have the details. Maybe you guys can tell me the details. How's it structured over how many years? How many people it's going to? What are the wrinkles in terms? Is it just time-based? Is it performance-based? Remember, the transaction's a bit shy of £10 billion. So the other side of the argument, I don't know what the total wage bill is of Schroders, including Cazenove, but it's a lot of money. So 175 million on one level, relatively, is a small sum of money if it's going to a wide range of people. But you need to look at the details.
Just one more question on this topic. There's a week, around a week before this deal dropped, I'd been talking to an asset management CEO who said the US are all over the UK wealth and asset management market. I mean, he wasn't kidding. A week later, this happened. Now, Alex, you've got some views on this. Why are US firms so interested in UK wealth and asset management?
Well, so I think loads of points to talk about. Yeah, so we cover a lot of M&A. The wealth management M&A market in the US is absolutely wild. It's fueled by PE. They're buying up. We call them RAAs, but independent wealth management firms in the US. Huge movement. I took some notes here, Dylan. Last year, Piper Sandler report, there were 344 deals for US independent wealth managers last year, of which 3/4 of those were basically executed by PE firms or other wealth managers backed by PE firms. So the amount of money chasing these deals is huge. And I think the reason why you're starting to see some of them look abroad is because the competition is so fierce in the US. There's firms that have, let's say you're a PE firm and you've bought sort of your cornerstone wealth manager, say it's like a $10, $20 billion firm, and you're going to use that to aggregate a bunch of others. We've spoken to sort of people involved in these deals, and they're saying there are guys behind those deals at the PE firms who basically, to make that acquisition pay off, to hit the growth targets, they're just trying to do like 10, 12 deals a year. So there's just every
roll-ups.
Roll-ups, exactly. So every firm that's on the market, there's about 10 PE suitors for it. And at some point, maybe if you're one of these firms, you're looking, well, how can I find a less competitive space? There's the discount as well. So the multiples that the US firms are going for are meaningfully higher than the ones in the UK.
It's partly an arbitrage.
It's an arbitrage opportunity. You're talking like, I think, in the US firms, you're talking sometimes up to 20x on EBITDA, whereas UK, maybe a similar firm would be like 14, 13.
Yeah. Do the businesses get better with scale? I mean, my question, flip the question is, what do the customers get out of this? The normal story from firms is we're giving you more product lines, it's a bigger firm, we can attract more talent, that's the sort of thing. But has there been any evidence, maybe you guys have got it on your AI search engines, is there a correlation, particularly with big fund managers, between size and after fee performance for customers? Because I don't think there is.
It's a really good question. I don't think we can answer that right now.
That's
but it's
a
something.
shame,
Can we answer that right now?
So fund management, I can't speak. Wealth management, it's a really good question. No one talks about it, do they? It's all about, is this a good deal for the buyer? Is it a good deal for the seller? No one talks about the client. In theory, what you should see, economies of scale. Do the advice fees go down? And I think we all know the one part of the fee equation that hasn't changed, while passive has eroded management fees, is that the advice fee seems pretty sticky at 1%. So maybe what we should see is that. In theory, that should come down.
Well,
right?
hasn't it?
It should,
open to
with
competition.
scale. That kind of leads us nicely into our final topic, our final story, AI, and talking about fees. AI could drive some of those fees down.
You would have thought it.
Yes.
Your AI advisor, which no doubt you consulted.
No, it's maybe a sort of ironic shift. We've just been talking about 175 million
Are they worth
to
it?
retain human talent. And now we are talking about the threat AI poses. This is referring to a story we had at one of our wealth manager events a couple of weeks ago, where we asked delegates, so these were 100 or so wealth managers, whether AI presented a threat to their jobs, and they were split.
Or an opportunity. So you're probably going to get a bit of both.
Yeah, Edward, you are you're chair of a digital wealth manager.
A hybrid,
Yeah, so a hybrid. So I'm really interested in your view on AI and this threat, and how this impacts the client.
I know.
All that
well,
kind of stuff.
just take one step back. Look, the honest answer is I don't know. Also, I'm not convinced that many other people, including far cleverer experts, and no doubt you quote Anthropic and other tech bros in this. As to replacing fund managers' asset allocation, it's going to happen. It is going to happen because you're basically scraping the best of breed. So when I plugged in, I sit on a charity foundation, and I just, out of curiosity in my AI perplexity thing, said, what's a typical asset allocation for an endowment? And out it all comes. And then you can play with it, and I'm not a grey expert, saying if I want to beat inflation plus 3 or 4%, which I think your average private client would say, I want to do that, how would I do it? And so you might have a question now saying, what's a non-correlated asset in a world which we might be in today of stagflation? That's quite an interesting question. Where do you invest?
Let's bring Alex in here, the epicenter of AI. Anthropic has really...
Well,
in the UK, it feels like it's shaking things up.
It came out with this tool.
Claude? Not Claude.
Well, Claude's the underlying tool, and then there's actually another firm which is based off of Claude, came out with this tool, and they said, we can now do like comprehensive tax plans using everyone's all the various documents, and we can do it in minutes. And I think it was the in minutes part of that sort of statement. And as a result of this, you saw a lot of sort of large listed wealth managers in the US sell off. But I don't think that was entirely on the fears of, oh, this is going to replace humans. I think it was more like, actually, these advisors no longer need to be part of these wealth management organizations to whom they pay like a percentage of their revenues to each year. They can now do more by themselves. So I think it was less, the sell-off was less, this is an existential threat to human advice, in the short term at least, and more, this changes the business model of some of these larger wealth managers.
And that is all the time we have for today. A massive thank you to our guests, Alex Steger and Edward Bonham-Carter. For more breaking news and deep dives into the wealth industry, head over to citywire.com. We'll see you next week.